Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 7 a.m. Mountain Time, Monday morning, August 25th. I suppose the last day of summer for some of you, though I just saw a picture from my brother that his children in Boston are even going back to school. So I guess summer's perhaps over for a lot of you. Our note this week was titled The End of Unbalanced Policy. Prior to Chair Powell's Jackson Hole speech, a speech that surprised us a little bit because although we have been forecasting Fed easing and think they could go as much as 50 in September, we didn't expect him to give up the Fed's optionality or tell us that on Friday. We expected the second part of his speech, not the first. We titled the first section of the note Corbett's Callure. For those of you who are skiers, know that that's a really scary run at the top of Jackson Hole at the edge of the tram that pretty much have to point them and be brave to go down. And that's what we think Chair Powell did. We absolutely think he did the right thing. He acted with integrity, that it is time for the Fed to be easing policy. So in the first section of our note, we talked about him describing the labor market as in a curious kind of balance. We've been describing what he was characterizing as curious kind of balance as negative convexity. And what we mean by that is the models the Fed likes to consider the labor market utilizing the Phillips curve, the Beveridge curve. The labor market is in a very precarious spot where any further weakening of demand could lead to a very sharp increase in the unemployment rate. Governor Waller's been making that case, and apparently he finally convinced Chair Powell of that. He also described the effective tariff on prices as a reasonable base case that it'll cause a one-time price level shift. We would have gone even further than that and said, yeah, maybe in goods, maybe. But it's having a negative effect on everything else. But nonetheless, he is ready to get started. We then went on to a lengthy discussion about what we think the neutral policy rate is. And it's very important here, and this is what unbalanced policy is all about, to differentiate between the effects of the balance sheet on longer term rates and the volatility of longer term rates, and what policy is doing to short-term floating rate borrowers, small banks, small businesses, real estate developers. In 2022, when the Fed raised the policy rate above 3%, the markets shuddered. The yen shot up. The Bank of Japan intervened. The gilt market collapsed. Our mortgage market went bidless. Bank portfolios that they've been accumulating assets for the last 10 years when the Fed was holding rates below where they otherwise should have, started to lose money. The Fed's portfolio started to lose money. 3% is a level. Yeah, there's been some portfolio runoff since then, but that is a very key level. And you could see that in yield curves. You could see it in relative bank profitability, small banks versus large banks. Small banks' profitability is nearly 4% below that of large banks. 3% is where we need to get to, and it will not cause inflation to go up. That's just not the right way to think about it. What causes inflation to go up is excessive government spending. And while government spending is still too high as a percent of GDP, it's fallen from a 45% annualized rate in the first part of 2021 when inflation took off to its long-term 70-year median rate of 6.4% today. Monetary growth is down to 4.5% on an annualized basis. Its long-term median is 6.7%, and that was 27% in 21. We do not have the conditions in place for inflation, and that is really the bottom line. So we do think that we're going to get the 3, and it is going to be very good news for small banks. It is not going to cause a sell-off in the back end of the bond market. We saw that on Friday where 10-year real rates dropped when the Fed signaled that they're ready to start cutting rates. They didn't go up. Forget about all this. Oh, they went up last year. They went up last year because of fiscal policy risks and supply and related supply. That issue right now is pretty quiescent or tame, if you will. We had another discussion in the note about liquidity risks and the impact last week on high-risk assets. We do not think this is going to be anything like 21 or 22. We will be watching bank reserves carefully. Become a full subscriber and you get really into all the details of this stuff. and understand the inner workings of the markets and money markets and the like. The final section of the note, we discussed the sequencing of the real effect of tariffs, which is to weaken demand. And we listened to Walmart's commentary last week. They told analysts, yeah, we might be able to raise prices later on. That's baloney. Walmart has a very sophisticated pricing mechanism. So do Amazon. If they could have passed through tariffs, they would have done. We showed that how in June, we're now in August, the effective tariff rate was already up to 10.8% from 2.5%. If they could have passed through higher prices, they would have. It's hitting demand. Tariffs are bigger, have a bigger impact on aggregate demand than they are likely to create an inflationary impulse. That's the bottom line. So that is a risk, right? That demand weakens even further as those effective tariff rates go up. But that's why the Fed is going to be easing here and removing some of that pressure on small banks, small businesses. We do need consumption to stabilize. We'll watch it carefully. But the net effect of all this is small banks could have an absolute boom over the next, as long as 3 years. They're going to have policy tailwinds, regulatory policy tailwinds, and a normally upward sloping curve. And I'm talking about the 3-month, 10-year part of the curve, getting those deposit rates down, and deposit rates will fall sharply, could put their return on equity above 10%, and they'll build capital quickly. And that sector looks quite attractive to us. So that's it for me this week. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.